Hello friends, welcome back to AAFM Education Initiative. So today we'll take up the next question. So the next question we received, what factors influences interest rates and how do investors and institutions uses these rates as an indicator of overall economic condition and liquidity? So if you have gone through our first video, the previous video, there we have already spoken, I already spoke about one of the factor that influences interest rate is inflation. But here we will see that there are many other factors which is going to influence the interest rates. So the first one is demand for money. So if you look at any growing economy where the businesses are growing, new businesses start up in the country, the new era of entrepreneurs come in, people want to buy properties. So there are many reasons why people want money. People have requirement for large lump sum of money, and for which the borrowing becomes very important. One of the important tool to accomplish their desires, either in terms of expanding their business, in terms of starting a business, in terms of buying properties. So when the demand is high, you will see that the rates are also going to be high. As in normal accounting terms, we know that demand and supply. So when the demands are high, the price will go up. Similarly, here the demand for money is high, the interest rates are going to go up. So a country like India, which is a growing economy, you would always see that the interest rates has been consistently high compared to the other economies. Similarly, when you look at supply of money, so again demand and supply. So if there's a demand, the price goes up. If the demand is not there, the rates are going to come down. Similarly, over here supply. If there is an excess money supply in the industry, in the market, basically that is being controlled by RBI, the central bank. So when there is an excess supply of the market, you will see that the rates would be low. And when there will be a strict restricted supply of money, then you will see that the interest rates would go up. Okay. So the money supply is also another factor which is influencing the interest rate. The third one being fiscal deficit and government borrowing. So as you know that there will be some fiscal deficit for the government, whatever is the budget, and if they exceed that, if their incomes are less, if the government income is less and expenses are high. So to bridge that gap, what government is going to do? Government is going to borrow money by issuing the bonds, and also when again, when government starts borrowing money, the demand for the money increases. And again, at the same time, when the demand increases, the rates are going to go up. The next reason for change in interest rate is inflation. So inflation, as the prices increases, as the inflation in the country increases, there will be a requirement for change or increase in the interest rate. They both go hand to hand. RBI plays a very crucial role, as I have mentioned earlier also, that when they see that the inflation is going out of control, it has increased a lot, then they will also slowly increase the interest rate, and vice versa. The next reason is global interest rate. The global interest rate, when we see that globally, other countries, including the developed countries, if they increase the interest rate, the country like India will also have to increase their interest rates in order to compete, in order to become more attractive for the international investors to come and invest in the country. So the recent incident which has happened, where the interest rates in US and the European countries have increased and it is amongst the highest for the last 10-15 years for those countries. And to compete with them, because India gets lot of investments from the foreign countries, the FII investments. So whenever the interest rates in the foreign country increases, the money will be pulled back from India and it will go back to their own economies. So in order to retain the money in India, in order to make the country as a better alternative for investment, the country will have to increase the interest rate in order to attract the foreign investment. So that also will influence the interest rates. And last but not the least, the forex reserves, which is very much related to the global interest rate. So when you see that the forex reserves are depleting, it can be for many reasons. It can be because of the global interest rates where money has been pulled out of the country, or it can be because of the trade deficits where our imports are high and exports are low. So when the country sees that there is a uh, deficit in the trade and the foreign reserves are depleting because you are spending more and you are getting less amount. So when the forex reserves are going down, it is then the government has to increase the interest rate so that they can attract more money, more investments from the foreign countries. And when that happens, that will have a positive impact on the economy, because when more money is the more foreign reserves, the forex reserves increases in the country, it will lead to strengthening of the currency, your domestic currency against the dollar, and it will have multiple effects. It will have more positive effects because if your currency increases in value, your imports are going to reduce. Yeah, the cost will come down. Okay. And that is again going to have an impact on the stock markets. It is going to have the impact. So here, one of the second bit of the question which was been asked, that how do investors and institutions use these rates as an indicator of overall economic condition. So when you see that the interest rates are increasing, it is basically, to an extent, it's a matter of concern for an individual because it is going to pull down the overall economy scenario. Okay. So whereas the income, as the rates increases, as the interest rate increases, you will see that the domestic markets will have a negative impact, and that is how you are going to take the investment decision. You are going to take the decisions on the real estate, on commodities. So if interest rate goes up, it is an indicator that going further the real estate prices are going to come down. If interest rate goes up, it is an indicator that the banking stocks are going to come down. Okay. If the interest rate goes up, it is an indicator that the debt mutual funds are going to give you low or negative returns. Okay. So these are, somewhere connected to the technical analysis where we look at the interest rate and we take the decisions on our investments. We make certain assumptions on the overall economic development, the overall economy. So when you see that the interest rates are going down, you can actually predict to an extent that, okay, now interest rates are going down. It is going to give boost to the economy. So it is a positive sign. If interest rates are going to go down, you know that the banking stocks are going to go up. If interest rates are going to go down, you know that the stock exchange, the stock prices are going to go up. The banking stocks are going to get more benefit. So likewise, these are all interconnected and these are part of your technical analysis also. Okay. So this is how these interest rates and the factors are going to help the investors and the institutions to use these as an indicators to take their decisions and to have an assumption about the future of the markets and future of the economy. Hope this explanation has helped understanding this concept. Thank you.